Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 20th of January. I'm Daniel Lam, your host for the podcast. The official China GDP figure came out yesterday, growing by 5% in 2025. The booming exports offset the lackluster growth in the domestic economy. This is a challenge for Beijing's policymakers, as the economy is now more reliant upon exports to maintain growth, as Trump's policies create uncertainties over global trade. Now, digging deeper, industrial production exceeded expectations, while most indicators of domestic demand, from property to retail sales, disappointed. The birth rate also hit a record low. This shows longer-term structural issues in the domestic economy. The unbalanced growth may prompt the authorities to put up more stimulus in 2026. Now, this dichotomy also applies to equity sectors. We've spoken about how the industries mentioned in the 5-year plan tend to be sought after by investors. Now, in the previous 5-year plan, industries mentioned gave 40% average return, while the CSI 300 was slightly down during the period. In the new 5-year plan, where most of the focus industries are related to AI and technology, investors should follow the policies and focus their investment of Chinese equities on those areas, i.e. new economy over old economy. Moreover, we can see safe haven demand from investors on global equities. Now, as US and Europe, they have growing tensions over Greenland, we can see rotational demand from investment funds on Asia and on Chinese equities. In terms of currencies, we see growing resistance to a stronger currency from China's authorities. Now, as we spoke about, the country relies upon exports to support growth, and an excessively strong RMB is not to the exporters' interests. Moreover, a stronger RMB can increase the already prevalent deflationary pressures. So aside from stepping up intervention via state banks, Chinese authorities may intensify resistance to CNH appreciation via counter-cyclical factor, liquidity measures, greater capital outflows, easing restrictions on overseas borrowing, and further monetary easing. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.